Hello, everyone. Welcome to A2IM Indie Week 2022. My name is Eric German. I'm a partner at Mitchell, Silberberg, and Knupp in Los Angeles, California, although I am currently in New York City, sitting here talking to you. And this panel is called Catalog Sales, Everything You Need to Know in 45 minutes, right? Without further ado, because there is a lot for you to know, and we're going to try to get you as much information as possible, I will say that while that's quite the ambitious panel title, we have an esteemed panel of panelists today that'll really help get us as much as we possibly could get there within that time period. So without further ado, I'm going to introduce briefly each of the panelists and then give them a moment to tell you about themselves. First and foremost, we have Glen Barros, who anyone who is familiar with this organization should know. Glen, why don't you introduce yourself and tell them what you do.
Thank you. I'm with Exceleration Music now, which is a relatively new company, but I've spent my whole life in the music business. And for the majority of that time, I was the CEO of Concord Music Group. So over the 25 years, it was 25 years at Concord. I think first 15 or so years was organic growth and a few strategic acquisitions, and then the last decade was very much centered on mergers and acquisitions. So in terms of catalog sales or company acquisitions or so forth, there was probably about 35 meaningful transactions. But I left 2 years ago and started Exceleration Music, which is a company that was really designed to invest in the indie space, the indie label, indie artist, publisher, and so forth. And it was really an observation of what I thought was needed in the market to create a company that could bring institutional capital into the indie sector, and also maybe some operational support. So it's been 2 years, and we're about seven meaningful transactions in, and counting. So.
Thank you, Glen. And so from a legend in the independent community, we'll take it to a legend in the music valuation space. Don't look around, but I think I'm talking about Barry Massarsky. Barry, please introduce yourself to everyone.
Thank you very much. I honestly feel I get a little bit too much credit that way, but that's fine. My name is Barry Massarsky. I am a partner at Citrin Cooperman, and I help to be a co-practice leader of their music economics and valuation services program. But that's all new to me because up to January of 2022, I was the president of Massarsky Consulting for 29 years. And we built a company, a consulting firm, brick by brick, starting with the RIAA, and we actually helped to form a company that became Sound Exchange. Work a lot in the music publishing sector as well. We would do a lot of analysis of performing rights for Warner Chappell, Universal, Sony, and others. But I think we got on the map, the way that Eric describes it, about 18 years ago, as all of our data was so well organized for music valuation study, and I guess we'll spend some time talking about that. And we became, quite frankly, the leading music valuation firm for not just publishing, but for masters catalogs as well. Last year, we literally reviewed $6.5 billion of asset value in the music industry, over 320 deals, and we're 50% growth from that going into 2022. So there's a lot of work being done by somebody, and there's a lot of reasons why the music catalog business is here to stay. I have a lot to say about that subject. This is the most fantastic market expansion I've seen in my 40-year career. And I am really happy to be here on this panel. I have some data to share as well because I can't help myself, and we'll do that in due course. Thank you.
Thank you, Barry. And now to segue, the perfect segue between the valuation, investment capital into now who is becoming a buyer in some creative spaces, Daniel Yearwood from Mission Road Sound. Daniel, please introduce yourself.
Hello, everyone. My name is Daniel Yearwood, originally from Trinidad and Tobago. I'm the CEO of Mission Road Sound. We are building a vertically integrated DeFi protocol for music NFTs. So on one side of the business, we're raising an SPV to go out and buy catalogs of music, especially focused on undervalued catalogs that are, in different niches geographically or in terms of the subgenres that not a lot of people are focused on. On the other side of the business, we're building a DeFi protocol that will allow people to use a music NFT as collateral, borrow against it, or lend it, earn interest. And eventually, when we have more volume of music cash flows in the Web3 space, we're going to build a suite of different investment products. This is also very new for me. I've spent most of my career on the investment side, investing in hedge funds, VC, private equity, and most of my historical reference with the music catalog space has been in evaluating different music IP funds and thinking about how those investment products could fit into client portfolios. So I've been doing that for a number of years. I'm also an artist, which is one of the reasons that I sort of stumbled down the path of becoming a founder. I like to tell people that I accidentally started rapping, but that sounds silly, like you trip and you fall into a recording studio. But that was about 6 years ago, and now, I continue to work on my music alongside my startup, and, very happy to be here with some of these folks that have been doing this since, before I was born.
What a great thought that is.
Well, with that, thank you, Daniel. We have, last but certainly not least, we have Joe Puthenveetil from Raine Capital, who their company has made many strategic investments in the music space, and Joe is actively assisting buyers in identifying assisting sellers in identifying opportunities in the space today. Joe, please introduce yourself.
Thanks, Eric. Great to be here. Thanks for having me, especially on this panel of legends. Raine, we do two things. We are investment bankers and we are investors, everything media and technology, along with a couple of my colleagues, Rob Freck and Jay DeJeja, who are here, and Fred Davis, who we work very closely with. We lead everything we do in music. So as advisors on the catalog side, we've done things like help Downtown sell their publishing catalog to Concord. We're working with a couple of independent labels right now on monetizing their catalogs. We've helped some of the majors acquire joint ventures. We've seen it from both sides. But we also work more broadly across music, everything from helping Alamo Records when they shipped it over from UMG to Sony, helping some independent labels like Hitco and Venice and Q&A raise initial capital to get started, and working with a lot of the technology across the independent space, companies like Fuga and AVL Digital and CD Baby. And then as investors, we're equally as passionate about the music space. We've done everything from live events like C3 Presents to SoundCloud, where we've been pushing further and further to partner with independent labels. Most recently launching a company called Firebird, where we've raised a few $100 million to go out and partner with independent labels and managers and help them build their businesses around great talent. I'm so excited to be here. Thank you.
Thank you, Joe. So we've all heard a lot about big numbers, big splashy deals, headline-making transactions, but the terminology kind of gets bandied about catalog sales. What does that really mean? What are some of the types of deals that you see out there? And we'll start with Glen. Glen, what kinds of transactions are you looking at with Exceleration?
Well, with Exceleration, we're looking specifically at, we're looking at everything really, but we're focused on primarily label acquisitions. And it's not so much acquisitions, it's investments. The thing that we realized is that you have really an unprecedented time right now where you have institutional capital coming into the business, not necessarily just for strategic purposes, which has always existed, but also for just pure investment purposes. People are looking at music as an asset class and very often comparing it to other alternative type assets. So what we've tried to do is to say, look, this is an asset class, but it's also an art form. And the people here at this conference have, spent their lives in music. And so the thought was, how can we provide a service that addresses some of the issues that go beyond the financial? So, for example, if you've built a label up over years, you're going to be concerned about your legacy, you're going to be concerned about your relationships, your artists, your employees, and so forth. So the idea was to invest in those situations where maybe we could solve for those problems as well as the financial side of things. Not to say we're not looking at music publishing deals or anything else that might be creative, but it has predominantly been toward the label side of things because we understand that world, very well. My partners and I, there's one of them right there, Dave. And
Well, Glenn, you mentioned your partners. Like for this room, I think it's a very relevant group of people that are part of Exceleration.
yeah,
Can you speak to that?
Dave Hansen, who spent a lot of years at Epitaph. Charles Caldas, who of course was the CEO of Merlin for more than a decade from its inception. Amy Dietz, who's been a main part of the indie landscape, most recently at InGrooves, and John Burke, who was with me at Concord for my entire time there. So, and then we've built a team around that of people that come from all different parts of the music business, but who are music people. And so, even though we are making investments, and that is a huge component of what we're doing, and we're bringing investment capital into the indie landscape, we're doing it through the lens of independent music executives. And so that's sort of the main distinction, and that was the one thing that we saw when we started the company that we thought was missing in the ecosystem.
So for many that are looking for exit strategies for their business, that sometimes you're saying they miss the legacy curation component of it, that you guys could bring a different perspective.
Yeah, I think the big investment funds want no strings attached deals. How can I buy music rights, generate cash flow, not have to worry about all of the other softer issues, which can be time consuming, they can be just challenging. And so the idea here was how, if you're an indie label that is worried more about those other things than just top dollar, how do you deal with that? Who's going to care? And so this was to try to solve for that problem while at the same time addressing the financial needs of the entrepreneur.
And sticking with you, Glenn, is there generally a sense in some of these deals that it's really about the catalog with a forgotten component of it being the forward-facing, continued ongoing business? How does that work? And what do you do with these founders as part of these transactions?
Yeah, so, yes, I think very often investors are looking at the catalog of rights and what the cash flow off of that's going to be. That's not to say you don't also look at the value of potential future recordings and what they might generate as well, but certainly the catalog is what's valued. So, for us, what we've looked at is, in each of our deals is sitting down with the entrepreneur or the partner and really assessing the needs, right? What is it that you're trying to accomplish? In certain cases, it's, look, I think the market's obviously very hot. This may be a time to exit, but I don't really want to exit. I want to keep doing what we're doing. And so what we've done, for example, is make an investment or actually acquire a catalog or a company, but then offer a production deal where we finance future records and we bring our team to bear to help do things that indies often don't like to do all that much or sometimes don't do so well. So things like data management and distribution and back-end administration and so forth. So all those things we can help that entrepreneur do going forward while continuing to do what they really love, which is make records and market records.
Thank you. Barry, when we talk about these types of deals, what rights are we talking about, or what rights are you actively involved with? Are we talking about publishing, master? Obviously relevant to this room is the master rights, but are we also talking about PRO, neighboring rights, name and likeness, trademark value? What kinds of things are brought to bear, and the difference between acquiring an ownership stake versus acquiring just a revenue stream? How does all that factor into what you do?
Thank you very much, Eric. God, everything is relevant here. Let's step back just for a moment, should we? About 6 years ago, the commercial banks that lend capital to support these valuation opportunities came to me and said, can we trust a master's deal? You know, they came from a stark period when record companies relied on the physical sale of records, and there was a little bit of mystery about how to analyze net label share. They weren't comfortable with the product. They didn't know how to forecast it. They would rather invest in music publishing assets than in masters. And then the revolution called streaming took place. Really, I think for me, at the apex of that was when the major record companies did license deals for partnership shares with the digital audio service for the first time ever, and created such a benefit for the marketplace. Just last year alone, as you well know, streaming grew 24% over its peak the year before, and that was 18% from the prior year. And once streaming took over as the main dominant force of value, revenue for masters, it became a very playable opportunity for the banks because it had a much more greater level of transparency. It was easier for them to understand, and then they rushed into the market to support the marketplace. When that happened, I'm sorry, I'm going a little bit astray from your question, but I'll get to it, I promise. Private investors also started swallowing up master deals. So sometimes the best way to look at this is look at some numbers, right? So when we look at the market and the kinds of deals that are played, such as passive rights, which is maybe just sound exchange royalties, or maybe it's both active and passive, or maybe it's just artist only, or maybe it's just the first 3 albums of an artist's royalty stream, or many variants thereof. We sometimes talk about it in terms of multiple of net label share or net publishing share. Multiples are not very accurate. They don't tell you anything about the catalog that's being valued. They give very little information about how to look into the future value of any one asset deal. But they are a bellwether for how the market is doing in some sort of global way. So you can only use it with great caution. So in the last couple of years, if we just look at publishing deals and how they traded, and we did so many of these deals, so we're only looking at our score of information. Publishing itself grew in 2019 from an average of 13 times cash flow with net publisher share to 14.6 to 15.28. And that includes legacy, standards, and new music. But look at what Masters has done with publishing. It has actually exceeded, in 2021, the average multiple for a master publishing deal, because all these master deals have some small publishing component attached to it. The average multiplier was 16.66 of net label share against the average for publishing of 15.28. How did masters become more lucrative and more valuable?
What's that first number?
For publishing?
One before 15.
There was 15.28 for publishing and for 2021, and for masters and publishing, 16.66.
So Barry, we can end the panel right now, right? Because that's what everyone came to hear.
But it's not. It doesn't tell you anything but
Exactly.
direction.
Please explain why.
It's just a direction. Because what happens is you go inside these deals, and there are all kinds of advances that have to be reviewed. There's settlements that have to be taken out. There is the future new releases that have to be concerned. There's pipeline that has to be measured. There is the format sometimes can make a difference.
And what about the rest of this stuff? The neighboring rights, I guess, is part
So
of
neighboring-
master
so we
rights,
have-
or name and likeness.
So what happens is when we look at it from a process point of view, and I know Daniel's anxious to talk about the same subject, we're looking at it from certainly streaming, right? But also physical and download. We're also looking at it from sync or licensing, sound exchange, and neighboring rights. Those are the revenue streams that what we're going to do is we're going to look at an average over the last 3 years of activity for each label to try and get a marker on what the future growth might be against any one of those summary revenue sources. I just want to end this quick piece of this by saying that the marketplace not only is strong because of itself, and there's so many ways for us to measure it that way, but Masters, the side that you guys I think are more involved in, is even more faster growing in appetite for either a loan, you don't just have to sell what you have, in terms of getting collateralized loan value for it, or to sell. It's actually eclipsed the rate of growth from what publishing has been experiencing. That's the market called masters.
Thank you, Barry. Daniel, I enjoyed our conversation the other day where you were telling me as an acquirer, you're going to be looking at some kind of non-traditional revenue streams, whether it's metaverse, NFT. You're also looking at geographic and genre areas that are maybe not traditionally the focus of some of these acquisitions. Can you speak to that, both of those issues?
Sure. So in terms of my background, all of my investing experience has been in the hedge fund space. So the general idea that, what a hedge fund does versus a traditional, long only equity fund is try to find these little pockets of value that are either underrepresented or underfollowed. I sort of had that concept and thought with all of the growth in the amount of data and streaming, is there a possibility to take that same sort of philosophy with respect to identifying?
You're playing Moneyball.
Purchases? Yeah, that's a good analogy. That's a good analogy for it. So we started out by doing this broad data collection exercise where right now we collect daily play count data on about 80 million songs, and when we analyze that, we find these little pockets of opportunity that if you were trying to deploy huge sums of capital, it would probably be too intensive to do all of these smaller transactions over and over to find these pockets. But just like a hedge fund relative to a large, long only fund, you can run a long only equity fund with several billions of dollars, 20, 30 billion, and still be fine. Whereas, with a hedge fund, once you start getting over a couple hundred million, it then becomes hard to take substantial positions in some of these smaller companies. So we sort of have the same approach where, if we're able to find these, niches that are either geographically underfollowed or, subgenres that aren't necessarily, top of mind for people that are acquiring music, or also newer releases that, people traditionally want to wait until these songs and these catalogs have longer periods of
So they might
historical
be
revenue.
temporally undervalued. They might be geographically undervalued. They might be genre undervalued.
So that's our focus, trying to find these pockets of value that we think, are less trafficked in, and as a result, we could potentially find really good opportunities.
Thank you. Now, Joe, you mentioned earlier, I know that you help and you assist a lot of sellers in identifying appropriate buyers. I'm sure you asked one of the best questions when we were prepping of how we talked about NFT and metaverse. Daniel didn't really speak to that, but I know he wanted to exploit those kinds of rights, I think, with some of his acquisitions. You asked how do you value that in a deal? So let's talk about that. Let's also talk about, I'd love to hear from you, how you help the seller identify appropriate buyers. And then I want to kick it to Barry and have him answer the question that Joe asked in the prep.
Sure. So I'll start with the second half. How do we think about who potential buyers are? And I think you've heard a bit of it from everyone here, but part of what excites us is that particularly for the independent community, there's more options for who to partner with than ever before. I think even 5 years ago, for a lot of people in their mind, it would have been going to one of the majors to get a joint venture or P&D deal, maybe in advance. Maybe if you're big enough, you could go to one of the commercial banks, but they wouldn't touch masters a few years ago. Nowadays, I'd say it's, maybe it's slowed from once a week to once every 2-3 weeks, but there's a new billion-dollar fund popping up just to invest in catalog. And there's a lot of, I think you're starting to see a real variety from people who are just purely financial investors, to Glen's point about this becoming more of an asset class, and they're happy with kind of mailbox money, and they don't need you to be involved anymore, to people that will actually be partners and look after your legacy and think about your business like Exceleration. And so there's this great breadth of options out there, and it really depends on what everyone in this room wants to do with their business or with their assets. And so it's a very bespoke situation in terms of who the buyers are, but that list of options keeps expanding, which is great for everyone. To the point about NFTs, metaverse, we spend a lot of time in video games and fitness. this fundamentally excites us because music intersects with pretty much every format of media and is so core to the experience. And that just means new opportunities to monetize. And when you look at the way music is monetized relative to the hours of consumption versus any other format, it's drastically under monetized. And so, whether it's tapping into the consumer side of NFTs, where it's the super fan, or actually revolutionizing rights management and kind of making it a B2B opportunity, there's going to be a lot of upside long term. And we're probably somewhat conservative in terms of how we think about streaming growth, because anyone who's looked at the industry over time, formats shift in music faster than anywhere else, and it tends to happen in 10 to 20 year cycles. So, is streaming going to be around for the next 10, 15 years as a dominant, consumption format? Probably not. But will there be other ways that people discover and interact and monetize music? Absolutely. And we think that's just getting more and more efficient and creating more opportunity for everyone.
Wait, Joe, did you just say that streaming's not going to be around for 10 or 15 years?
I said as the dominant consumption format.
Right.
Yeah.
Well,
If anyone has kids in this room, they're probably finding music on Roblox and Fortnite and gaming platforms, right? And Spotify's for old people in their mind.
Joe, what's really interesting is that's exactly true. This is why music is such a great investment tool, because just when streaming is getting all the media attention, we go into social media licensing, and we have an explosion of value. We're talking about now license deals, not litigation and settlement with Roblox and and with Facebook and with other social media types, Peloton originally, that is also augmenting value. That's the thing about this business. It's finding new ways to curate new value on top of additive revenue streams that they themselves are already doing well. And it might be a good time at this moment, Eric, if I could just jump into it, about what does it mean to value an asset?
Right.
Because I think that's kind of an illusory term. Here's how we do it, and it's how the market kind of looks upon it. It's technically called a discounted cash flow model. And let me tell you what that means. That means that we're going to predict what the revenues are going to look like for a specific catalog for a period of 15 years. We're going to look at the growth rate over the most recent 3 to 5 year period. We're going to compare that against other experiences for other similarly situated catalogs. So we have growth and experience to do so. We have different ranges of growth rates and different expected value. We're going to then, in the mid-year range of the 15-year, allow the industry growth rates to take over after the individual catalog values start to move or merge into the market growth. And then at the end of it, year 15, we're going to have a terminal rate, which simply means what will it grow ad infinitum as copyright continues to grow. We'll place a recurring value at the end of that cycle. What's really, really strategically important is then you have to bring back those revenues and you discount the cash flows based on, we call it the discount rate, but it's really the implied market internal rate of return. What will the investors want to reclaim as their value, their rate of return? Because that has to, that has to be part of the expectation. And it's really the economists that do the modeling that set the market value. Now, you might have been reading a lot about interest rates and inflation growing and eroding the value of these catalogs because investors then have alternatives once these asset classes become less desirable to other more traditional investment concerns. But we in our business have set the discount rate traditionally so high at 9% that it is like a shock absorber for all these potential increases that are likely to occur over the next several years. We did that because the revenue cycle of the market is so exciting and so vibrant that the market grows organically on its cash flows, not from a tool called implied discount rate. Because if you lower the discount rate, you increase the value of the catalog. They're inversely proportional. But that's really a fake way of looking at the model. The model should benefit from the revenues associated with individual catalogs, not from some overestimates of what the discount rate is. So we did a whole study of this that got published in Music Business Worldwide and why we set it at the rates that we do set it at. So the end of my story is that it's all based on growth of the catalog, physical, streaming, license, neighboring rights, sound exchange, all marked differently, all with gross growth rates assigned to those particular revenue segments, moving into how the market will handle it after the growth of the catalog, moving to a terminal rate, which is an implied sort of like what it will continue to grow ad infinitum, and then discounting it by a rate of 9%. Boom, what do you get out of all that math? You get the net present value of these future cash flows. That's the number that the market is interested in looking at as the investment value of the catalog. And then when you take that number and you divide it from the most recent year's cash revenues, that's what's called a multiple.
All right,
So that's how the multiple works.
So let's first of all, we lost about 3 A&R reps during that. But
You were about to get that.
24 people leapt out of their seat. Then I see a couple reporters over there taking notes. So
I can't help myself.
I think that was excellent. Thank you. Now, in a more kind of music biz sense, Glenn, can you tell us how are you valuing these opportunities in less of an accounting sense and more of how do you see the opportunity?
The reality is we actually do exactly what Barry just described. We do actually use discounted cash flow models, but what we look at is the growth projections will differ for every label, right? So what you're really looking at is the intrinsic music. I mean, you have to understand genre differences. Very often people apply a growth rate, and that growth rate comes from market numbers. But you may have a different growth rate for the particular genre of music. You may have a different growth rate based on the geography, right? Because different markets have grown at different rates and are projected to grow at different rates. You have artist variation, right? You can look at each artist within a catalog. Usually catalogs have a few key artists that drive the revenue. So you have to look at that and see what are the opportunities with that artist? What's happening with the artists? Where's their career at the moment? So you look at all these factors, and then that gives you a couple of things. One, it gives you a sense of where you think the label's going, gives you a sense of what you think you can do with it, and what other additional value you can bring. And it also gives you a sense of the risk.
Do you think if something, say, was underworked previously, that matters? Does it matter that the artist is still in a good relation, that they're active or they're touring?
Absolutely.
That
And
kind of stuff?
artist relations, to the seller, or if you're continuing on with that entity and those people, what are the relationships that individual has with their artists? That's key to this whole thing. So all these other elements come in, and then what that helps you determine is, Barry talked about the discount rate being at 9% as a market discount rate. Well, if you're buying something that has a lot of risk, right? You're looking at numbers that could be very volatile. There could be a lot of upside, there could be a lot of downside. You're gonna want a better return than 9%, right? And so it gives you sort of you get to the numbers by making the general assessment of what it is that you're investing in.
So let's say you see a label that is a potential acquisition target, and perhaps they haven't been run as efficiently as they could have. You think you can do better? That you take that into account?
Absolutely.
Right.
And there's, there are certain, it's not necessarily do better, it's usually do identifiable things, right? So I've never been one to believe that just because you touch it, it's going to do better than what the other person was doing. In fact, it's usually not the case. But there are usually things you can identify that will absolutely happen. So for example, if you know that your distribution deal is cheaper than the one that you're acquiring, you're going to get a pickup in income there. If you look at it and say, well, vinyl has been growing at a tremendously fast rate over the last couple of years, and this label hasn't really put much out in vinyl. So there's an opportunity. You can go in and make an assessment and say, we've got X number of titles that we can release, and you can absolutely project those kinds of things. Sync, right? If a label's not been very aggressive on the sync front, you can make an assessment that you think you'll get a little more. You usually want to be careful with that because that's hit or miss, but you do look at those things, and all those things factor into the growth projections that you put in place and put into the DCF model that Barry described.
Thank you. Daniel, you were talking about looking for those undervalued pockets. Do you use similar metrics to what these guys are talking about, or is there more gut involved?
No, I think overall it's a very similar approach. One other point I wanted to make, sort of to build off of what they were saying. I spent a lot of time in sort of like the institutional asset owner world, and I think what you see today that's very different from years ago is there's a lot more comfort and familiarity with the space as an asset class. So when you think about, when rates were at zero for such a long time, and that whole pocket of institutional investors' portfolio that was fixed income is now like sort of useless. Like, there's no reason to own much fixed income when rates are at zero. Then you think, okay, well, what else can I do that is sort of a substitute for that? And there's been growing levels of comfort and familiarity with music IP as sort of that idea that it fills that bucket. It's not necessarily credit that has a certain risk premium associated with it. So notwithstanding the fact that rates are increasing now, I think you're going to have a meaningful offset in terms of just institutional money that is coming into the space. So with 9% as a benchmark, I mean there are lots of people who are very happy to earn 8 or 9% with relatively low volatility of those cash flows. So I think there's still going to be a tremendous amount of growth in the space.
Thank you. Joe, what is data and chain of title, and how does all that factor in when someone approaches you to help them find an acquisition? What goes into that, and how do you get involved with all of that? How does that impact value?
I'd say more broadly, it comes down to just kind of being prepared when you decide to go sell something, and making sure that you're presenting the distribution fee properly, and you're taking credit for the fact that someone else is going to get a better deal, and making sure that you've laid out all your revenue streams properly and given people the data so that Barry can come up with the right valuation. And it's, despite being in this age of streaming and data, it's still surprising how messy and manual a lot of this can be. And it takes time to make sure that it's cleaned up properly, that there's no skeletons, but also make sure that you're getting credit for, the right pockets of value, like sound exchange revenue, right? And making sure that's accounted for properly, and making sure that there's no hidden liabilities or, advances that haven't been paid. And there's lots of different pockets of income, of liabilities, of data ultimately that kind of help inform how you position things and help people value it ultimately. But one thing I would say, just you kind of wonked out on discounted cash flows for a while, and that's all right, but it's still music. It's an art form. It's emotional, and the reality is, part of what you want to do is drive competition and find people that will place that premium on things. Similar to fine art, right? No one sits there and looks at a discounted cash flow model for a Picasso. And I think you're starting to see some exceptional cases of that in the market with, blue chip artists, particularly from the 60s, 70s. But, and Barry's colleague had a great quote in the FT that I'll paraphrase, but though a lot of those premium valuations have gone to artists that resonate with the people that tend to occupy the seats of those billion-dollar hedge funds. But when you look at the data, Tupac, frankly, is a lot more valuable than Bob Dylan, just in a purely financial sense. And so why isn't Tupac getting the, and obviously they haven't sold the catalog, but the 30, 40 times NPS multiple or NLS multiple. And so, part of that is, a lot of inherent structural issues, but part of it is, starting to think about this more as art and more of a store of value, which I think, again, plays in the NFTs than just a spreadsheet.
Yeah.
Thank you. Now we're running out of time. I really want to hit this real quick. Each one of you just quickly forecast the market. Where do you see things going? Glenn?
I think it's going to stay pretty heated. I think you have, clearly you have, with interest rates going up, that could depress things a little bit, but I think at the same time, music is uncorrelated to the financial markets, so it's an attractive alternative asset for all the new money that's coming in. So I think things stay pretty hot.
Barry?
We have an equilibrium between supply and demand in the marketplace. We have plenty of opportunities for new funds that are looking to acquire assets. We have grown the supply chain by virtue of different types of music interests. We have expanded the array of things that are getting sold, and everything is up for a potential deal. So because of the energy of the competitive marketplace that fuels the drives these valuations, I see the next 4 or 5 years to be very comfortable for market value.
Thank you, Daniel.
Agree with that completely. I think one of the dynamics that Joe was just mentioning in terms of the premium that some people place on art as NFTs become more popular and become a vehicle for I don't know if you want to call it retail investors to participate, as opposed to all of this premium value being driven by the rich hedge fund billionaire that wants Bob Dylan. You have somebody who's a retail investor that puts a premium on some indie artists that they resonate with, and what they'd be willing to pay for that NFT. I think there's going to be a lot of similar sorts of premium that are going to work its way through the market over time.
Thank you, Joe.
I agree with the smarter guys on the panel. That's what they say.
Well, that now everything you needed to know about catalog sales right there in 42 minutes and 9 seconds. We have 3 minutes and change left for some questions. I did see some hands go up. He's going to present a microphone. We'll go right there to this gentleman. Thank you.
I'm in a unique situation. I have a, reasonably worthy body of musical property, and it's pretty clear.
Introduce yourself.
I'm Aaron Fuchs of Tough City Records,
Thank you.
and it's become reasonably clear to me that I could be in play to the extent that I want to be. My problem is I want to buy a couple of labels that I can't afford. And I find that the market for those who would invest in me seems to be much smaller than the market for those who would want to buy me out. Am I looking in the wrong places? Or?
Anyone want to take that? Daniel?
Well, I was going to say we should talk after this because you're the type of person that I'm trying to find. But
I think there's plenty of options out there, especially for someone that knows how to operate and monetize a body of work. That's available skill set as Glen and team have proven. So you might be competing with Glen, but there's lots of options out there.
Other questions?
Yeah, I have a question, please. I'm Turkish. We represent some of the largest catalogs in Turkey. So I wonder, did you ever made an international acquisition with those countries' large catalogs? Like that's something similar with Daniel said, like undiscovered gems and the potential hidden under. So for a long time, we've been working on developing this, but we are falling in the same pit as like indies. So if you had any experience with international acquisition, I just wanted to really get an idea about how did it go or how did it happen or did you ever do it?
I don't have that experience yet.
Yeah.
I have. I mean, we've worked with international catalogs, and I think one of the great things about the streaming world is that the borders have become a lot easier to cross, right? And so you now have music traveling all around the world, and it's easier to explore for the consumer to just experience music that they might never have bought in a purely physical world. So I think international expansion is a key part of what anyone like us or someone who's investing in copyright should be looking at.
Thank you. We got one more.
Yeah, just quick question. The multiples going up the way Barry described, and Glen, you actually said nobody's actually doing anything different. They're looking for unexploited, opportunities. Isn't there anything structural in the market that has driven these multiples, as opposed to just we can do it better?
Oh, it's the growth in the market that's driving the multiples, right? It's the belief that you're going to see continued growth for an extended period of time, and that growth is going to come from new things as well. So you have the streaming growth, which everyone can kind of see the curve on what that looks like, but you also have all these new things where you have new platforms coming on. You have the thing we haven't even thought of yet that's going to come in a few years, which we all know will be down the the pike. So I think all of these things are what's driving the multiples. It's the belief that music is a great growth story. And this is a pretty far departure from 2006, when I think Forbes magazine said, you know, is the music industry dead, right? So now you have this, it's probably one of the more compelling stories in media. And that's why these multiples are so high.
All right, well, it looks like we're out of time, but I just want to thank you, gentlemen, and everyone in the room. Let's go out and make some music, make some money. Thank you.